So good evening, everyone. I hope you people are able to write your names for attendance in the chat box. Those who have joined late, kindly write your names in the chat box.
Yes, ma'am.
Okay. So today we will be starting with the block fourth, and as per schedule, today we are going to have the last class. We will be still left with block 5, and then as per Smriti ma'am's instruction, further we will be having one more class. So the block fourth is dividend decisions. Now, when I start with dividend decisions, already many times I have explained you what is dividend. But again, just to recall, dividend is profit. The profit which is divided amongst the shareholders, equity shareholders, and the payment of dividend is not compulsory. The payment of dividend is not compulsory. It is on the discretion of the management as and when it feels it has to declare, it can declare. So it is the monopoly of the management whether to pay dividend or not to pay dividend. Am I clear? So when we talk about the profit of the company to be distributed, in that case, it is a part of profit, a portion of profit. So, a dividend of a company is the profit that is to be paid to the shareholders. So, all the limited companies that pay dividends, they have a fixed schedule to issue the dividends, to declare the dividends at times. Unscheduled dividends are known as special dividends or extra dividends. So regular dividends are those dividends which are declared on time, and unscheduled or extra dividend are those dividend which is which is distributed on special cases. So again, if I start with the meaning, then dividend means the part of company's profit that is to be distributed amongst the shareholders. So when we say that it is the part of profit that is to be distributed amongst the shareholders, it means that it has to be distributed only amongst the shareholders. So shareholders are the owners of the company. So when we borrow fund through the issue of equity shares, they are only going to get the dividend. So a dividend is the share of profits. If you have 100 rupees as the company's profit and the company decides to pay dividend 40%, then 40 rupees will be distributed as dividend. And the balance 60 rupees, which is not distributed as dividend, which is retained by the company, is known as retained earnings. So there is no compulsion, no obligation whether to distribute the profit 100% or not. So whenever the company generates a profit and accumulates retained earnings, these earnings can either be reinvested in the business or it can be paid to the shareholders in the form of dividend. The dividend is mostly paid annually, and the dividend per share is divided by the share price. The annual dividend per share divided by the share price is the dividend yield. So how you decide to pay the dividend? It is on the approval, on the discretion of the board of directors. Am I clear till this?
Yes, ma'am.
Yes, ma'am.
Yes.
Okay. So the objective of this block is to understand the nature and significance of dividend decisions. Now, whether to pay dividend, not to pay dividend, in which form we need to pay dividend, and the second part of this block is the various theories of dividend policy. On what basis the dividend is paid. So we will be going with 6 or 7 chapters in this block. It is the introduction part. Again, it is one of the important financial decision. If we go back to our block 1, and we have 4 financial decisions. I hope you people remember the financial management stresses on 4 financial decision. The 4 financial decision we have seen: the investment decision, the financing decision. Investment decision is in the form of capital budget. Financing decision is in the form of cost of capital. Liquidity decision is in the form of working capital management. And the last one, dividend decision, is on the basis of your block 4. That is how to pay dividend, when to pay dividend, and how much to pay dividend. So whenever the earnings are available to the shareholders, these earnings are equally divided in the form of dividend. And if the company feels that they require some money to be reinvested in the business, in that case, they will go for retained earnings. So, dear learners, the success of any business firm rests not only on the utilization of the funds, but also how you are going to manage the income that has been earned by the business operations. If you are able to manage the earned income properly, you pay the fair amount of dividend to the shareholders, you have a proper provision for reserves and surplus from that earnings, and also you utilize the resources in the proper manner. So the efficient management of income strengthens the financial position of the business, because we are not utilizing the whole amount to be distributed as distributable dividend or distributable profit, but a part is also retained in the form of non-distributable profit. So when we talk about dividend, it is important to know how the dividend decision works. It is an important area of decision making for a financial manager. When we distribute dividend, we need to identify that, is this dividend going to affect the value of the firm? Is it going to affect the cost of the capital of the company? And to find out the answers for all these questions, we go with the theories of dividend. So the first theory of dividend, or when we talk about the aspect of dividend, we need to find out the value of the firm. The value of the firm is denoted by the word V. And there are various variables which act in this. The variables are, just now I told you, it may be investment decision, it may be financing decision, it may be tax, it may be the flotation cost, it may be the dividend decision. So each and every aspect of the functions of financial management has to be studied properly, and in this context the dividend is one of the important variable. So when we talk about the theories of dividend, they're classified in 2 groups. The first group is whether the dividend policy is a relevant variable to enhance the shareholders wealth. That means, can we consider the policy of dividend to be relevant, which increases the shareholders' wealth? And again, I am repeating, shareholders' wealth means the value of the firm, the market value of the equity shares. So when we talk about increasing the shareholders' wealth, indirectly we are talking about increasing the value of the firm. We are talking about increasing the market value of the equity shares. The second theory talks about that if we consider the dividend policy, then it has no relevance in the valuation of the firm. And with this concept, with this understanding, we start with the first theory, and the first theory is named as relevance theories of dividend. When we say it is relevance theories of dividend, it itself means that the dividend policy is relevant in understanding the valuation of the firm. And under the relevance theory of dividend, we have three school of thoughts. First, it is the traditional theory. Next, it is Walter's model. And third, it is Gordon's model. The first one, traditional theory, it has been expounded or it has been proposed by B. Graham and D.L. Dodd. So, according to this theory, the stock market is overwhelmingly in favor of liberal dividends. Now, what is liberal dividend? We do not retain the earnings. We do not hold the earnings to be reinvested. Liberal dividend means that high rate of dividend is paid. So the stock market is overwhelmingly in favor of higher dividends. As per this model, as per this theory, the importance attached to liberal current dividends by the shareholder is more. The shareholders gives less importance to capital gain. They want their present income. They are not interested in getting retained earnings reinvested and capital appreciation, capital gain in the long run. So, therefore, the firms which pay more current dividend, that means regular dividend, will have higher market value compared to the firms which pay less dividend. So the traditional theory speaks about that if you pay more dividend, higher rate of dividend, regular dividend is termed as liberal dividend. So when you pay liberal dividend, the companies which pay liberal dividend has more market value compared to the firms which have less payment of dividend. And this is expressed in terms of an equation where P equals to market price per share, and then it is multiplied by D, that is dividend plus per share plus earnings per share divided by multiplier. So 3 will be the multiplier. So when we say that the above model E is earnings per share is equal to the sum of dividend per share and retained earnings per share. E is your earnings. E is your earnings. Earnings means your total profit. So when we say E is your earning and earning means your total profit, it means that total profit is only distributed as dividend and total profit is only distributed as dividend and retained earnings. So if your E is your total earnings, then E is equal to dividend plus retained earnings. I hope this equation is clear. And if we substitute this expression in equation 1, then we have the simplified equation as this. So according to this theory, we don't have to give the explanation. We are not going with the practical part, but it is important to understand that the view of liberal payout policy has favorable impact on stock prices. Favorable impact on stock prices means that it is going to increase the value of the shares. In the same concept of relevance theory, we have Walter's model, and Walter's model says that dividend policy is a critical factor affecting the firm's value. And according to the dividend policy, the internal rate of return, that is R, and the cost of capital, that is K, if we compare R and K, R is rate of return and K is cost of capital. So this model is based on the following assumptions. And if the assumptions do not work, the model will also not work. So according to this model, the firm finances new investment through retained earnings only. When you go for expansion or new investment is required, you do not raise the funds through the means of other sources. You raise the fund, you fulfill the requirement of the firm only through the retained earnings that you hold. The firm's internal rate of return, that is R, and the cost of capital, that is K, are constant. You will find no fluctuation, no change in the firm's rate of return and the cost of capital. 100% of the earnings is either distributed as dividends or reinvested internally. So, this is the third assumption. We say that the earnings are to be distributed in the form of dividend or in the form of, it has to be paid in the form of dividend or retained in the form of retained earnings. But again, when we talk about this theory, the assumption of this theory states that you are not going to have both the variables at one point of time. Either you are going to pay the earnings, 100% earnings, you are going to declare it as dividend, or the 100% of the earnings, you are going to keep it as retained earnings for further investment. So when you have 100% dividend, there will be zero retained earnings, and when you have 100% retained earnings, you will have zero dividend. The initial earnings and dividends remain constant forever. So the initial earnings and dividends remain constant forever. If earnings are constant, then dividend is also constant. So the earning per share that we denote by EPS and dividend per share, that is D, may be changed due to determined results. If the values of EPS and D are assumed to remain constant forever in the given value. So as per the Walters formula, this is how the equation is there. Market price of an equity share is dividend plus earnings minus dividend divided by cost of capital, and R, that is your R is your rate of return or return on investment, and K is your cost of capital. We don't have any practicals in this. This is just for understanding using the formula. So this Walters model brings out that the dividend policy does not help. It helps to maximize the shareholders' value if it is used properly. So if you go with the assumptions, then only the dividend policy is going to increase the value of the firm. There are three different cases, three firms to decide the optimum dividend policy. First, it is growth firm. Growth firm are the firms where we have good investment opportunities. Growth firms are the firms where we have larger returns and then we have less cost of capital. So the growth firms, they mostly, the value will be maximized when the firm reinvests 100% of earnings. You have a growth firm, the market opportunities are very good, the scenario of the market is good, your returns are maximized. So in such cases, you will not go for distribution of dividend, because if you know, if you invest more and more amount in the market, you are going to gain more and more earnings. So in growth firms, the situation is dividend 0% and 100% is the retention of your earnings. Why earnings are retained 100%? So that as per the market condition, it can be reinvested and more earnings can be gained. Normal firm means the firm which is having returns as normal. Cost of capital is also normal and the returns generated is also normal. So as a result, what will happen? The share value remains constant and then when we talk about paying the dividend, we can go for 100% dividend payout ratio, because it is a normal condition. It is not going to affect much the changes. So in such case, what is going to happen? In such case, we will be not in a position to retain earnings. We may go for 100% dividend payout ratio. When it is declining firms are those firms where the market condition is not good, and whatever you invest, your returns are not appropriate. When your returns are not appropriate, so whatever you invest, it is not going to give you much return. So you are just wasting your investment, because this is not the right time to invest. So in such cases, in declining firms, it is good to not go for holding the retained earnings. You go for paying the dividend. So in such case, we go for 100% dividend payout ratio. The criticism of this Walter model is that if you go with the assumptions, there is no external financing. The whole financing is dependent on your retained earnings. We also talk about the assumption that there is a constant rate of return and constant dividend rate. So in such case, where you have constant cost of capital and constant return, the firm's actual situation may change. So overcoming to this Walters model, we have another one, and that is your Gordon's model. What Gordon's model states? Gordon's model is a model which is used for stock valuation, and it is supporting the relevance decision, the relevance theory of dividend. It also states that the payment of dividend is having a relationship with the valuation of the firm, and it is taking into account the R and K concept. R and K concept is R for rate of return and K is for cost of capital. So dividend relevance decision is in case of a growth firm, and growth firm is the case. Which condition, which state you called as a growth firm? When your rate of return is more than your cost of capital. When your rate of return is more than your cost of capital, it is your growth firm. And what is declining firm? Declining firm when your rate of return is less than your cost of capital. Or otherwise, you can say your cost of capital is more compared to your rate of return. And then irrelevance decision in case of a normal firm. Relevance decision for growth firm and declining firm. Growth firm, we will go with 100% retained earnings. Declining firm, we will go with 100% dividend. Now comes irrelevance decision in case of normal firm. What is a normal firm? A firm where R equals K. What is R and what is K? R is your rate of return and K is your cost of capital. So a situation where your rate of return equals your cost of capital is a normal firm. And here, whether you pay 100% dividend or you retain 100% your earnings, it has nothing to do with the valuation of the firm. So this theory relating dividend policy and the firm's value is based on the following assumptions. And the assumption says that the firm has only equity capital and no debt. Only retained earnings will be used for financing expansion. This expansion mixes dividend and investment policy. Firm's internal rate of return has to be constant so that it can be comparable. Firm's discount rate is constant. The firm and its stream of earnings are perpetual. They are forever. And the corporate taxes do not exist in such theory. The retention ratio, once decided, remains constant. If the retention ratio is constant, it will lead to a constant growth rate of earnings. and the discount rate is higher than the growth rate. So again, we have an equation here, and with this, the first one, that is the relevance theory, ends. What is the implication of this relevance theory? The implication is that when the rate of return, that is R, is greater than cost of capital K, in such case, R is greater than K. The value of a share increases when the dividend payout ratio decreases. Therefore, what is required? Optimum dividend payout ratio is 0%. The second implication is that when the rate of return is equal to cost of capital and R equals to cost of capital is the case when we have normal firm. So R equals to K, the value of a share remains unchanged because it is irrelevance, and in irrelevance situation, whether we pay dividend 100% or we retain earnings as 100%, the value of share does not change. And in response, when the value of share remains unchanged, the dividend payout ratio changes. Therefore, dividend policy is irrelevant. And when the rate of return is less than the cost of capital, that is R is less than K, the value of a share increases, the value of the share increases as the dividend payout ratio increases. Therefore, 100% dividend payout ratio is optimum. So this is all about your relevance theory. And now coming to irrelevance theory. And irrelevance theory, again, it is a theory that states that the payment of dividend or dividend payout ratio is irrelevant if we compare it with the valuation of the firm. And this is given by M. Modigliani and Miller. This theory is also known as MM hypothesis. Why it is known as hypothesis? Because hypothesis means that it is an assumption. The total theory is based on assumption, and in assumption what happens? We take the conditions as it will be happening. It is not actual, it is just a situation. So hypothesis means only a given situation it can happen. So we will be starting with the second one, that is irrelevance theory. By the time if you have any doubt you may ask, otherwise we will move to the irrelevance theory, that is MM hypothesis. M stands for Modigliani and the other M is for Miller. So Modigliani and Miller has proposed this irrelevance theory. Irrelevance is what? It is not related with the valuation of the firm. So please let me know if you want to understand anything, or else I'll move to the next.
That was good for me, ma'am. Thank you.
So the first line you can see here, what it is written, the irrelevance dividend theory. It supports the view that the dividend decision has no impact on the valuation of the firm. So whether you pay dividend or you do not pay dividend, it has nothing to do with the valuation of the firm. This is an interesting model, and it concludes with the assumptions that dividend policy does not affect the firm's value. It is only the earnings of the firm, how to use the earnings, whether to retain it or distribute it. It is only about the dividend decision. Given the investment policy decision of retention and payout, there will be no effect on the firm's value. So this theory also has few assumptions, and the first assumption is that we have a perfect capital market, and the information that is available in the capital market is available freely. You don't have to pay anything for getting the information. The investors are rational investors, and they are aware about the investment policy. Rational investors means the investors who are informed. They have the knowledge of the market. Transaction and flotation cost do not exist in this theory, because if transaction and flotation cost will exist, it can increase the cost of capital. So transaction and flotation cost as do not exist, so it is not going to influence the investors. So securities are divisible, and company's investment policy is independent of its dividend policy. Taxes do not exist, or they are same on both dividend income and capital gain. The investors can forecast, they can anticipate the future prices and dividends with certainty and the proper discount rate. So these are the assumptions of irrelevance theory. And this irrelevance theory says that any gain in stock value resulting for an increase in dividend is exactly offset by a decrease in the stock value. So if there is any gain in the stock value, any gain in the valuation of the shares resulting out of dividend, it is going to offset, minimize the value at the end of the period. So shareholders are indifferent between current dividend or capital gain. Whether you have present income or you wait for future income, it is nothing to do with the valuation of the firm. It is only a matter of your current earnings. So we have certain assumptions for this, that the tax differential, we have a same tax rate on both capital gain and dividend, that is dividend income. Flotation cost, we say that the cost of retained earnings and external financing are the same. If there is any flotation cost, it is same on the retained earnings and external financing. We have certain transaction and monitoring cost, that is also same. We have an existing of perfect capital market where the buyers and sellers can come together and decide whether they have to invest or they want to go for retained earnings. Diversification, it says that either you can go for investment, and when you go for investment, you have a diversified portfolio of securities. There are many options available. So when we go with this, what does this says? That the impact of dividend decision on the value of a firm and its cost of capital is contradicting. The traditional view, it holds that it is not supported by any evidence. It just suggests that liberal dividend policy is there to enhance the value of the firm. And the Walters and Gordon's model in this traditional theory, they explain that the firms are categorized into three groups: growth firm, normal firm, and declining firm. So when we have a growth firm, 100 is the growth firm, 100 is your retention. For normal firm, it may be 100 retention, it may be 100% dividend distribution. And for declining firm, it is 100% dividend. Finally, when we talk about the next one, that is irrelevance model, it holds that the value of a firm is independent decision and it is not to be taken or mixed with the dividend decision. Dividend decision is a decision only to be taken related to the distribution of your earnings. For valuation of the firm, we have to compare the cost and the rate of return. So this is all about your ratios, your dividend ratios and the impact of dividend on the company's value and wealth. We have dividend payout ratio and PE, the ratio of market price per share to earnings per share, how to find the cost of equity, how to find the equity share value. So these are the few terms that we have come across. And now we'll be moving to the next part, dividend policies. In fact, we should have gone first with this, but as per the block, it is in the next part. This is actually the introduction part where we try to understand the various forms of dividend, various types of dividend, the factors which affect the forms of dividend, and different dividend policies followed by the company for distributing the profits. In this, we will be starting with the simple thing, one thing to be clearly understood, that dividend decision is a decision which is taken for distribution of profit. And distribution of profit rests on the group of people, and that group of people are known as the board of directors. So the board of directors, they decide whether you require to be paid with dividend or 100% retention. And even if you are going to be paid dividend out of the net earnings of your company, then what will be the percentage of dividend? How this dividend has to be paid? So this is somewhat a decision-making complex process of all the limited companies taken by the board of directors and of course the financial manager. Once the decision is taken related to the dividend distribution, it is only a suggestion and recommendation, and it has to be forwarded to the shareholders for their formal approval so that it can be finally agreed in the annual general meeting of the company. So the disposal of profits, the distribution of profits in the form of dividends is a very controversial issue because it is sometimes conflicting the interest of the interested parties, various parties like directors, employees, shareholders, debenture holders, etc. There may be a conflict that some may want present income, regular income, others may be interested in reinvestment of the capital and they will be interested in getting the capital gains in the long run. Hence, the formulation of the dividend policy is very complex and it needs various careful consideration on different factors. If we start with the forms of dividend, or we can say the types of dividend. So dividend is a distribution of profits. This is very clear. And when we distribute dividend, it is not necessary that they are to be distributed in the form of cash. The profits which are to be distributed in the form of dividend, they can be first category distributed as stock dividend. Now, what is stock dividend? Stock dividend means the dividend when you issue the shares instead of paying the dividend in cash. Again, I will repeat. When we issue shares instead of payment of dividend in cash, it is known as stock dividend. This stock dividend, when issued, the class of shares is from the equity shares, and these shares are known as bonus shares. These bonus shares are paid from accumulated reserves, and then they are capitalized in the long run. Thus, while the funds continue to remain with the company, because you have not distributed, you have only capitalized your capital reserve, so you have more chances of reinvesting the amount. So the first category is bonus shares. When dividend is not paid in cash, but shares or stocks are issued against that, it is your bonus shares. The second category is stock split. Stock split means that if you have a shares worth rupees 10 per value, and after the split of stock, it will become 5 rupees per value. So the single share is divided into two, and the value of the share will be half. The third is stock repurchases. Stock repurchases is stock repurchases is when you go for repurchase of the stock to change the capital structure of the company. When we have exceptionally high returns in the company, exceptionally high returns to the owners, then when the companies with exceptionally good liquidity position, they try to go for such options or buyback of shares. Property dividends, when your personal property is paid, the property of the business is attached or assigned for payment of dividend. Debenture dividend, you issue debentures against the payment of dividend. You issue the debentures of the company to the shareholders. Scrip dividend, the company may not have sufficient funds to issue dividends, that is, or they need some amount in near future. So these dividends can be paid out of profits earned in the particular year or in the past reflected to the company's accumulated reserve. From your accumulated reserve, if it is paid, then it is your scrip dividend. A scrip is issued, a note is issued, promissory note, and after few years, it will be convertible. Liquidating dividends, when the board of directors they wish to return the capital originally contributed by shareholders as a dividend, it is called a liquidating dividend. So at the initial time when you have contributed in the capital of the business, and if it is returned, it is your liquidating dividend. Coming to the factors affecting the dividend, so first it is ownership consideration, and the second one is firm oriented consideration. Ownership consideration means that what the owners want. Do they want the dividend to be distributed, or they want to retain the amount with the business? So first consideration, first factor is the current income requirements of stockholders. What the shareholders want. Do they want the current amount, or they want to hold it for the later? Then if they don't want to take the dividend at present and they want to go for reinvestment, then where the funds are going to be reinvested, how the funds are going to be invested, it is the second alternative. And third, it is tax matters affecting the shareholders. That is, if you take the dividend now, what will be the implication of tax? And if you go for capital appreciation, then in the long run, what will be the tax implication? Second, it is firm oriented consideration, that is from the firm's point of view. So the ownership interest alone may not determine the dividend policy. A firm needs to also go with certain important considerations, and the first one is contractual and legal restriction. Contractual and legal restriction means that during the investment, during raising the funds, what they have decided. Are they going to distribute the dividend, or they can go for the holding of the profits as retained earnings? Next, looking into the requirements of fund of the for the company, whether the company is in a stable liquidity position, whether the firm needs more working capital, and so on. Next, of course, it is the dividend decisions, what to be paid, when to be paid, and how much to be paid. Next, it is availability of external capital. You may require funds in near future, and if you do not have much options for your external capital, then of course you will rely on internal financing. So, for internal financing, you will go for less dividend and more retained earnings. You are also going to compare the cost of capital for raising the funds from the external source. If the financing of external sources are high, cost of capital from market is high, then you will go with internal source, and in that case the dividend will be less. Business cycles, if the firm is in a growth period, growth firm, you will go for no dividend and 100% retained earnings, and vice versa. And last, post dividend policies and stockholder relationship. The shareholders are going to continue in the company or not after the declaration of dividend. That is also an important factor. So these are the factors on the basis of which the company decides whether to go with dividend distribution or not. And if you go for dividend distribution, then in that case, what will be the percentage of your earnings to be distributed as dividend? What will be the form of dividend distribution, cash, stock, scrip? So these are the important determinants which decides the dividend policy of a company, or the factors which are responsible for taking any dividend decision. I hope till this I am clear.
Yes, ma'am.
Yes, ma'am.
So now we are going with the determinants of dividend policy. So the dividend policy determines the distribution of earnings available to shareholders, or earnings per share between dividend payment and retention. So when we talk about the earnings per share, it is equal to the dividend per share plus retention per share. Total profit is your earning per share, and this total profit is distributed into two, that is dividend and retention. So what will be the percentage of dividend and what will be the percentage of retention? This is a very important factor, and this is studied under two categories, under two factors. It is your external factor and internal factor. The external factors are those factors which are uncontrollable and cannot be influenced by decisions of the management of the company. So the external factors are those factors which are uncontrollable and cannot be influenced by decisions of the management of the company. So even if the management doesn't take the decision, they cannot control it. The finance manager has to adopt his policies whenever there is a change in these factors. The first is the state of economy. When we talk about the state of economy, it means that the economic condition of the country or state. How it is going to affect the dividend policy? If you say the economy is passing through a very boom or prosperity period, growth period, then all the businesses will be into their expanding stage, and in that expanding state, the market price of shares will rise rapidly. So when the company need funds for expansion and diversification, so therefore, looking into the economic condition of the state, they are going to use the funds more for expansion activities, for reuse in the business, for reinvestment, and then they are not going to pay the dividend. The second part is the state of the capital market. Capital market means the market where the funds are available. How much it is related to the access to the people, to the investors. So if the market is ready for more equity issue, the company accepts the equity issue, then the company may go for liberal dividend policy. Otherwise, if the funds do not accept the equity issue, firm doesn't like the equity issue this time, then the funds, then the company will go for retention of earnings. Tax policy already discussed. If the dividends are more taxable in the hands of the shareholders, then the shareholders will be in the highest tax bracket, and they would prefer not to receive dividend. But instead, if they have to pay low tax after receiving the dividend, then they will be wholeheartedly welcoming the dividends. Inflation, it is a factor where the firm's dividend decision is going to be affected. So during the inflation, funds generated from depreciation may not be adequate to replace the own out equipment, because each and every asset, if you're going for expansion and other activities, then as it is an inflation period, you are going to have it in higher rates. So you will not go for expansion, and instead you will go for high payout ratio. And of course, requirements of institutional investors. The dividend policy of a company is affected by the requirement of institutional investors, such as who are the institutionals? Who wants this dividend policy? Who wants the dividend to get? The institutional investors are the companies. When companies invest in the equity market, it can be the financial institutions, it can be the banks, insurance companies, mutual funds, etc. So these investors are usually in the favor of payment of regular dividends. Internal factors. The internal factors are the nature of the business. If you have a continuous income, every year you are going to declare dividend, then you are going to follow a liberal dividend policy where you are going to pay dividend every time. Secondly, you are going to pay dividend at higher rates. So your firm income decides the dividend policy. Composition of the shareholders. Composition of the shareholders means how much it is going to affect or influence the income of the shareholders. If the shareholders belong to low income brackets or retired people, they will be requiring more regular income compared to the young people who can wait for capital appreciation. Alternative use of funds. If the company does not have any alternative proposal with them for the retained earnings to be used, then in that case they will go for declaration of dividend and more dividend. Control. If the company adopts a liberal dividend policy, in such case they may attract more investors, they may go for more issue of shares, and so on. So if you go for issue of more shares, then you are inviting more equity shareholders, more owners of the company. And when you invite more owners in the company, this is going to dilute the control of the existing shareholders, as you are going to increase the proportion of the equity shares. So the shareholders may not like to get their control to be diluted. Just a minute, I'm coming back. So again, coming back, next it is desire for liquid funds. If you want more funds to be retained in the company, in that case, you will go for declaration of less dividend. And if you want to have more dividend to be distributed, you do not have any problem with liquidity in the organization, in the firm, in such case, you will go for maximum declaration of dividend. Now, types of dividend policy. Types of dividend policy. When we decide the dividend policy, these are the following aspects which have to be taken care. Dividend policy is analyzed on the basis of how much it is going to affect the value of the company. Dividend investment and financing decisions are interdependent, and there is often a trade-off, a balance between the decisions. Second, dividend decision should not be treated as a short-run residual decision that you have earnings and you are distributing it in the form of remains, the balance, but how it is going to impact the valuation of the company. Even if there is a zero dividend in a particular year, you need to identify the repercussions of the company that may result out of zero dividend. Dividend policies adopted by the company, the general principles is the dividend policy should be paid as far as possible, because the investors also require certain amount in the form of regular income. So in order to understand, the dividend policy should be taken in accordance with the understandings of the requirement of the shareholders. Erratic and frequent changes in dividend should be avoided, because the reduction in the rate of dividend is a painful thing for the shareholders, because already they have a plans for the dividend, for the incomes that they're going to get. And if there is a frequent changes in the dividend policy, in the declaration of the dividend, the management may not further able to convince the shareholders for further investment. So there are different dividend policy options. The dividend policy, the first one is whether dividend should be paid right from the initial year of operation, that is regular dividends. The company sometimes holds the profits for the first 5-10 years and then it starts paying dividend. So the first important decision the company needs to take is that whether they will go with the payment right from the first year of operation in the form of regular dividends, or whether equal amount of fixed percentage of dividend to be paid every year without any fluctuation. There is a stable dividend policy. Stable dividend policy means the dividend policy where you do not make any changes in the years. It is fixed, it is constant. Such dividend is policy is known as stable dividend policy. The third category is a fixed percentage of total earnings be paid as dividend, and this fixed percentage may vary every year depending on the quantum of earnings and the increase or decrease in the number of equity shares. So various different dividend policies the company adopts. First, it is stable rupee dividend policy. Stable policy, I told you, where the company is not influenced by the earnings. They have a stable dividend and every year they pay that dividend. Incremental dividend policy. Incremental dividend policy means that if they receive a growth in the dividend, that then in that case, along with the stable dividend, they will also pay dividend, which is an increase in their income. So if anything excess, anything extra income they have, earnings are more compared to the previous years, then along with the stable dividend, they will get additional dividend. Stable dividend payout ratio policy. The dividend payout ratio is the ratio dividend to earnings. Under this policy, dividends fluctuate with earnings. So they have a percentage. The percentage varies. If your earnings varies, then the percentage, as per the percentage also, it will vary. For one, if the percentage is 40%, in that case, for 1 lakh 40%, your dividend amount will differ compared to the 40% in rupees 2 lakhs. Residual dividend policy. After paying out all the dividends, if anything is left, the leftover is also paid as dividend to the existing equity shareholders. Smoothed residual dividend policy. The smoothed residual dividend policy is more appropriate, in which case dividends will show a steady progression. That means they will increase year after year. First it is 5, then 10, then 20, like this. Kindly read this summary. It is there on the screen. And if anything you need me to explain again, I will do that. I hope this is all done. If you have any doubt, please feel free to ask. Any explanation you require? Any explanation you require? Just respond.
No, ma'am. All good. Thank you.
Okay, I will just show you one video, recorded video. This is related to financial management so that you understand what it is. Just 1 minute. Can you see the screen?
Yes, ma'am.
Okay.
Yes, yes.
Can you listen to the sound?
Yes.
Yeah,
Okay.
we can hear it, ma'am.
Hello everyone, this is Alpa Ghosh, Assistant Professor, Department of Management, the Bhopal School of Social Sciences. Today I am going to introduce you with the subject Financial Management. The learning objects of this subject will be meaning of finance and its definitions, meaning of corporate business finance and its definitions, financial management meaning and definitions, types of finance and objectives of financial management. Upon successful completion, you will be able to demonstrate an understanding of the overall role and importance of the finance. Describe the financial environment within which organizations operates, and will be able to evaluate the financial objectives of business, concerns and the requirements of stakeholders. So let's start with the meaning of finance. Finance may be defined as the art and science of managing money. It includes financial services and financial instruments. Finance is also referred as the provision of money at the time when it is needed. Finance function is the procurement of funds and their effective utilization in the business concerns. The concept of finance includes capital, funds, money and amount. As each word is having unique meaning, studying and understanding the concept of finance becomes an important part of the business concern. Let's start with the definition. The definition of finance, according to Professor Khan and Jain, finance is the art and science of managing money. According to the Oxford Dictionary, the word finance is management of money. So when we talk about finance, we can also come to the conclusion that there are types of finance. Finance is one of the important and integral part of business concerns. Hence, it plays a major role in every part of business activities. It is used in all the area of the activities under the different names. So let us classify the finance into two groups. The first one is public finance and the second is private finance. Public finance, it concerns with income and expenditure of government such as central government, state government and semi-government financial matters. The second one is private finance, which includes the individual, firms, business or corporate financial activities to meet the requirements. From here, our scope of study starts. We in financial management are concerned with only private finance and that too business or corporate finance. The definition of business finance, according to Professor Willer, business finance is that business activity which concerns with the acquisition and conversion of capital funds in meeting financial needs and overall objectives of a business enterprise. According to the thoughts of Professor Gutman and Doggle, business finance can broadly be defined as the activity concerned with planning, raising, controlling and administering of the funds used in the business. So, when we conclude with the business finance, we can say that it is the activity only concerned with planning, raising, controlling and administering of funds raised in the business. Now, let us come to the point financial management. Financial management is an integral part of overall management. It is concerned with the duties of the financial managers in the business firm. It is concerned with the efficient use of the important economic resource, namely capital funds. The most popular and acceptable definition of financial management as given by Professor S.C. Kuchal is that financial management deals with procurement of funds and their effective utilization in the business. Here procurement of funds means the raising of funds. The raising of funds through different sources and using that fund only and only for business activities. Thus, financial management is mainly concerned with the effective funds management in the business, and that is to the fund which has been raised. In simple words, financial management as practiced by business firms can be called as corporate finance or business finance. Financial management is the operational activity of a business that is responsible for obtaining and effectively utilizing the funds necessary for efficient operations. The objectives of financial management: the effective procurement and efficient use of finance lead to proper utilization of the finance by the business concern. It is the essential part of the financial manager. The financial manager must determine the basic objectives of the financial management. Objectives of financial management may be broadly divided into two categories. The first one, profit maximization, and the second one, wealth maximization. So let's start with profit maximization. The main aim of any kind of economic activity is earning profit. A business concern is also functioning mainly for the purpose of earning profit. Profit is the measuring technique to understand the business efficiency of the concern. Profit maximization is also the traditional and narrow approach which aims at maximizing the profit of the concern. Ultimate aim of the business concern is earning profit. Hence, it considers all the possible ways to increase the profitability of the business. Profit is the parameter of measuring the efficiency of the business. So, it shows the entire position of the business concern. There are few arguments which are in favor of profit maximization. These points are in support that a firm should always aim at profit maximization. So, let us start with the first one. The main aim is earning profit. Business is an economic activity, dear children. So, why not earning more and more profit? When the business is established to earn profit only, so we should also aim at earning more profit. Profit is the parameter of the business operation. Yes, the efficiency of a business is measured in terms of profit of a business. So, when we are being assessed on the basis of the profit that we generate in the business, then what is harm in generating more and more profit? The third point states that profit reduces risk of the business concern. Yes, profit reduces the risk because if we do not aim in earning more and more profit, we can have a loss or less profit also. The fourth point states that profit is the main source of finance. Profit is the main source of finance in a way that the accumulated profit is used as the main source of internal finance in the organizations. So, the organizations aim at earning more and more profit. Profitability meets the social needs also. There is an obligation of the firms as per law to comply with the social responsibilities. A firm with less profit or with no profit is not in a position to go for the welfare of the society. A firm with more and more profit can only think of discharging the corporate social responsibilities. So, in order to give welfare and benefit to the society, the firm always needs more and more profit. There are some thoughts that are against the objectives of profit maximization also. The profit maximization leads to the exploiting of workers and consumers. The owners start exploiting the workers and employees by not paying them properly. They are not paid with their wages, salaries, and incentives. They are also required to work beyond the working hours without proper overtime allowances. They are also not provided with proper hygiene conditions in their working places. Due to the mindset of earning more and more profit, the inferior quality of raw materials are purchased and the production process carries without proper use of technological advancements, resulting more prices charged from the consumers. The second argument against profit maximization states that it creates immoral practices such as corruption and unfair trade practices in the industry. It also states that profit maximization leads to inequalities among the stakeholders such as customers, suppliers, shareholders, etc., because they are not properly paid as per their efficiency and efforts in the organization. The profits earned are not equally distributed amongst all the factors. This creates an atmosphere of distress amongst the stakeholders in the organization. Though profit maximization is one of the objectives of financial management, dear learners, it has certain drawbacks also. The first drawback that has been stated is it is vague. In this objective, profit is not defined precisely or correctly. It creates some unnecessary opinion regarding earning habits of the business concern. Example, for some it may be profits after depreciation and tax, but for others it may be earnings before tax. For some it may be operating profit and for others it may be net profit. So, we are coming to the second drawback. The second one is it ignores the time value of money. Profit maximization does not consider the time value of money or the net present value of the cash inflow. It leads certain differences between the actual cash inflow and net present cash flow during the particular period, as the value of money is not the same in future. The third drawback is it ignores risk. Profit maximization does not consider risk of the business concern. It always goes with the saying, more profit, more risk. Risks may be internal or external, which will affect the overall operation of the business concern. In spite of these risks, the concern always aims in earning more and more profit. So, coming to the second objective of financial management is wealth maximization. Wealth maximization is one of the modern approaches which involves latest innovations and improvements in the field of the business concern. The term wealth means shareholders' wealth or the wealth of the persons who are involved in the business concern. Wealth maximization is also known as value maximization or net present worth maximization. This objective is an universally accepted concept in the field of business. Here, by value maximization, we mean that the value of the shares are being increased, which ultimately is due to the profits. Wealth maximization also has certain supporting arguments in favor. Wealth maximization is superior to the profit maximization because the main aim of the business concern under this concept is to improve the value of the wealth of the shareholders, which ultimately benefits the firm. Second, wealth maximization considers the comparison of the value of cost associated with business concern. Total value detected from the total cost for the business operation. It provides extract value of the business concern. The third one is wealth maximization considers both time and risk of the business. Wealth maximization provides efficient allocation of resources. It also ensures the economic interest of the society. Now, coming to the arguments which are not in favor of wealth maximization. The first one, wealth maximization leads to prescriptive idea of the business concern, but it may not be suitable to present day-to-day business activities. Wealth maximization is nothing. It is also profit maximization. It is the indirect name of profit maximization according to some thinkers. Wealth maximization creates ownership and management controversy because the management never wants to increase the wealth of the shareholders where their own interest is hampered. Management alone enjoy the certain benefits. The ultimate aim of wealth maximization objective is concluded as profit maximization. Wealth maximization can be activated only with the help of profitable position of the business. So dear students, this is all in today's session. Thank you for your patience listening. Hello everyone, I, Alpa Ghosh, Assistant Professor, Learning. Let's have a quick look on what we are going to cover today. Definitions of capitalization, concepts of capitalization, theories of capitalization, types of capitalization, and we will start with fair capitalization. Capitalization is one of the most important constituents of financial plan. The term capitalization has been derived from the word capital, and in common practice, it refers to the total amount of capital employed in a business. If the definitions are properly studied, we can classify them in two ways: a broad interpretation and a narrow interpretation. Broad interpretation of capitalization, many authors regard capitalization as synonymous with financial planning. Broadly speaking, the term capitalization refers to the process of determining the plan of financing. It includes not merely the determination of the quantity of finance required for a company, but also the decision about the quality of financing. Used in this sense, capitalization includes estimating the total amount of capital to be raised, determining the type of securities to be issued, and determining the composition or proportion of the various securities to be issued. In its narrow sense, the term capitalization is used in its quantitative terms and refers to the process of determining the quantum of funds that a firm needs to run its business. According to the scholars holding this view, the decisions regarding the form or composition of capital fall under the term capital structure. According to the definition of Gutman and Doggle, capitalization is the sum of the par value of stocks and bonds outstanding. The above definition considers and includes in capitalization only the par value, that is, the face value of shares and debentures. It does not include reserves, surplus, which usually form part of the long-term funds of a firm. According to Justenberg, capitalization comprises of a company's ownership capital, which includes capital stock and surplus in whatever form it may appear, and borrowed capital, which consists of bonds or similar evidences of long-term debt. Thus, the essence of all these definitions is that capitalization is the sum total of long-term securities issued by a company and the surplus not meant for distribution. According to the modern concept, capitalization includes share capital, long-term debt, reserves and surplus, short-term debt, and creditors. Now to start with the theories of capitalization. There are two important theories to determine the amount of capitalization. The first one is the cost theory and the second one the earnings theory. According to the cost theory of capitalization, the amount of capitalization is arrived at by adding up the cost of fixed assets like plants, machinery, building, etc., working capital required for the continuous operations of the company, the cost of establishing the company, and the promotional expenses. Such calculation of capitalization is useful in case of newly formed companies, as it enables the promoters to know exactly the amount of funds to be raised. But this theory is not totally satisfactory, as it ignores the earning capacity of the business. Now, if you look at the cost theory of capitalization, the amount of capitalization is based on a figure which will not change with changes in the earning capacity of the business. For instance, if some of the fixed assets of a company become obsolete, some remain idle, and the others are underemployed, the total earning of the company will naturally fall. But such a fall in the earning capacity would not reduce the value of investment made in the company's business. The earnings theory of capitalization also recognizes the fact that true value of an enterprise depends upon its earning capacity. According to this theory, the capitalization of a company depends upon its earning and the expected fair rate of return on its capital invested. Thus, the value of capitalization is equal to the capitalized value of the estimated earnings. Let's have an example for better understanding. If a company is making net profit of rupees 2 lakhs per annum and the fair rate of return is 10%, the capitalization of the company will be rupees 20 lakhs. A comparison of actual value of capitalization with its value will show whether the company is fairly capitalized, overcapitalized, or undercapitalized. Earnings theory of capitalization seems to be logical because it correlates the value of a firm or the amount of capitalization directly with its earning capacity. However, this theory can only be applied when the firm's expected income and capitalization rate can precisely be estimated. In practice, it is very difficult to estimate correctly the future earnings as well as to determine the capitalization rate. The future earnings of a firm depend upon a number of factors such as demand for its products, general price level, efficiency of management and productivity of labor, etc., which are beyond the control of an organization and may vary with the change circumstances. In the same manner, it is very difficult to determine the capitalization rate, which depends mainly on the expectations of the investors and the degree of risk in a particular enterprise. In view of these difficulties, newly established firms prefer cost theory of capitalization. However, earnings theory may provide a better basis for capitalization of an existing concern. We are starting with types of capitalization. There are mainly three types of capitalization witnessed in the industries: fair capitalization, overcapitalization, and undercapitalization. In this video, we will be only taking care of fair capitalization. The rest too will be continuing it in the next video. So, first one is the fair capitalization. It is the desire of every company to have a fairly capitalized situation. That is, neither overcapitalization nor undercapitalization. Right amount of capitalization is the basic objective of a finance manager. Fair capitalization is that situation where the business has employed the correct amount of capital and its earnings are same as the average rate of earnings. Under fair capitalization, every rupee of the fund mobilized is used profitably. Neither is there any shortage of funds, nor is any fund left unutilized. This can be done by balancing the debt and equity component in capitalization. But, my dear learners, fair capitalization is totally a myth. So that's all for the day. Thank you, and we will be seeing you on the next.
So I hope to a certain extent the introduction is clear to everyone. Yes,
Yes, it is.
I will forward you the links of these videos. So at times, if you require any explanation, you can go through these videos. Okay, these are the videos recorded from our college cell only under e-content. So I will forward this. Am I clear?
Yes,
Yes, you are.
will be very
So I
helpful.
hope everyone has given your attendance. So I'm just ending the class. And whenever Smriti ma'am is going to schedule the 5th block, we will be having one more class. Is it clear?
Yes, ma'am.
Okay. Yes, it
Yes,
is.
ma'am, it is.
So thank you everyone.
Thank you very much.
Thank you. Thank you, Grace.
Thank you so much, madam.
Thank you.
Thank you so much, madam.
Thank you everyone. Thank you. And we will be having one more class. Okay.
Okay.
So my number is there with Grace. In case if you feel like contacting me for any queries, any understanding, clearing any doubt, you can feel free or just text me. I will get back to you.
Okay, thanks a lot, ma'am.